Now, ladies and gentlemen, I want to go ahead and introduce Dan Pazzarelli. Now, Dan Pazzarelli is an author, trader, and former member of the Chicago Board Options Exchange and CME Group. Dan has written 2 books on options trading, Trading Option Greeks and The Market Taker's Edge. He is also the founder and CEO of Market Taker Mentoring Incorporated, a leading options education firm that provides online options education, options newsletters, and personalized one-on-one coaching for options traders. The company's website is www.markettaker.com. Now, Dan began his trading career on the floor of the CBOE as an equity options market maker. He also traded agricultural options and futures on the floor of the Chicago Board of Trade, now a part of the CME Group. In 2005, Dan joined CBOE's Options Institute and began teaching both basic and advanced trading concepts to retail traders, brokers, institutional traders, financial planners and advisors, money managers, and market makers. In addition to his work with the CBOE, he has taught option strategies at the Options Industry Council, the International Securities Exchange, CME Group, the Philadelphia Stock Exchange, and many leading options-based brokerage firms. Dan also contributes to financial media such as TheStreet.com, FX Business News, Bloomberg Television, BNN, National Public Radio, and the CBOE blog. And he has a weekly featured video on CBOE TV. Now, without any further ado, I want to go ahead and thank Dan for his patience, and the floor is all yours, Dan.
Hey, thank you very much, Christian. I very much appreciate that. Thank you, thank you, thank you. So, welcome, and Christian, thank you very, very much for the kind introduction. I really appreciate that. Today, we are going to be talking about something really important, guys. We're going to be talking about time spreads. Time spreads is probably the most powerful option strategy you can use. It's the one that, if you know what you're doing, you can gain an edge over other traders, and it's one that we're going to talk a lot about today. A couple ground rules. I'm going to save some questions until the end of this presentation, but if you have questions during the presentation, I'd love to hear them, because you know what? Somebody else might have the exact same question, so feel free to fire away, as long as it's, you know, somewhat relevant to what we're talking about. I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading, and you can get a copy of that by calling 1-888-OPTIONS. That's the home of the Options Clearing Corporation here in Chicago, Illinois. All righty. How many of you are familiar with time spreads? You guys know what I'm talking about when I say when I'm talking about time spreads? Okay, some yeses, some no's. I get a C from my student here, Lorraine, and Jerry's here too, and Lawrence is here too. This is like a market taker reunion. Great. Okay. Well, for those of you who said no, and there was a few of you, time spreads are on the surface, they're pretty simple. They're two options, either both calls or both puts, and you buy one, let's just say call, and then you sell another call that has a shorter amount of time until expiration, but has the same strike price. All right? So on the surface, pretty simple, pretty straightforward. Buy one option, sell another, you know, easy. But I'm going to show you a trick here that probably nobody's ever shown you. All right, this is something that I teach all my students at Market Taker. All you guys, Lawrence, Lorraine, Jerry, Kat, you guys have seen all this before. But for those of you who aren't my student, I bet nobody ever taught you this, and it's something that every professional trader uses all the time on all their trades, but I don't know why people don't show their students. I do, because you have to know this. So really quick, here's what a typical time spread looks like. You know, maybe we buy the March 20 calls and sell the February 20 calls. Pretty simple, pretty straightforward. We pay 105 for these longer term March calls, sell these shorter term 20 calls, This, of course, prices are not current. This is just an example. I'm just kind of showing you what it looks like on an option chain. So again, on the surface, easy breezy, right? There's two ways that you need to consider the risk of time spreads. Absolute risk and incremental risk. Then that's how we look at the risk of all option trades. And you're probably used to using one or both of these ways of looking at risk. Absolute risk, that just means you assume you hold the position all the way until expiration and that there's no time value left, and you basically look at a profit and loss diagram. You guys use profit and loss diagrams? Who uses profit and loss diagrams? Everybody does, right? You guys are option traders who use profit and loss diagrams. Incremental risk, that measures changes in the pricing factors that affect your options before expiration. So, maybe I buy I put on a time spread today, or it could be any option position. Maybe I buy a call today. And today, the stock goes up. I'm still, a month away from expiration. The stock goes up $1. How much money do I make on that? The profit and loss diagram doesn't help you with that. It doesn't help you at all. They just assume that you hold it until expiration. So we need to look at what? Delta for that, right? What if a week passes? We don't hold it until expiration, but a week passes. How much money do I make or lose? Well, I need to look at theta. What if volatility changes? I need to look at vega. So that's looking at the Greeks. Now, once you get to the point of being an intermediate option trader, you probably start to use at least some of the Greeks. Even if you're a basic option trader, you probably use profit and loss diagrams. It's probably one of the first things people teach you. Like a long call, it's like the hockey stick kind of thing, right? You're familiar with that. But here's the problem. Because when you draw out a profit and loss diagram, it assumes you hold it until expiration. That helps you with most option strategies, but with time spreads, there's a logistical problem. There's two expirations, right? There's the long-term call that I buy and the short-term call that I sell. In the example I just gave you, I bought the March, I sold the Feb. So if I hold it until expiration, which expiration? Well, logically, the one that we would consider is the expiration that happens first, the shorter-term option. But then when that option expires, I still have a longer-term option that is not at expiration, and it still has time premium, and based on some of the factors that affect the value of an option, I don't really know what that option is going to be worth. I don't know what the March option is going to be worth at February expiration, even if I consider at various strike prices, various stock prices, like a profit and loss diagram does. So we kind of have a logistical problem here. We can't actually use a P&L diagram on a time spread. The only thing we really know is our maximum loss. Our maximum loss is what we pay for it. So the Greeks become very, very important when analyzing time spreads. Now, what was my last question? My last question was how many of you use profit and loss diagrams, right? Okay, new question, ladies and gentlemen. How many of you use the Greeks when you trade? Oh, of course, all my students are saying yes. And some of you guys who I'm not familiar with are saying yes also. Good, great. Donna uses some of them, delta and gamma. Okay, that's great, that's fine. Lorraine is one of my students says, I'd be in trouble. That's right. Well, look, for those of you who said no or just simply didn't answer, let me give you a little bit of a crash course here, guys. It's pretty simple, really. I know the Greeks can be a little bit intimidating. When Christian introduced me, he said I wrote a couple books on options. My first was Trading Option Greeks. As a market maker down on the floor of the CBOE, I used the Greeks on every single trade I ever made, so I became somewhat of an expert in the Greeks, and so I saw that a lot of retail traders don't use the Greeks. So that was kind of my passion. That was one of the things I really felt I needed to write a book on to help the average investor. So the Greeks is near and dear to my heart. Delta simply measures the directional sensitivity of an option. Stock goes up today, how much do I make or lose? Stock goes down, how much do I make or lose? Gamma measures how much the delta changes. Now, that's kind of the definition of it. A better way to look at it is gamma is simply a measure of your exposure to volatility. When you have positive gamma, when the underlying stock moves higher or lower, it helps you. You have positive exposure to volatility. Volatility is good. When you have negative gamma, volatility is bad. Now theta, and Jerry, another one of my students here in the room here, says, I love theta. Theta is a measure of how much you make or lose as time passes. When you have positive theta, time passing helps you. Negative theta, time passing hurts you. Vega is a measure of volatility sensitivity. Now, I know a lot of people aren't super schooled on volatility. I know some of you guys probably are. Some of you guys, I'm going to give a little bit of a crash course because volatility is at the heart of success with trading time spreads. So let's take a look at how the Greeks affect the time spread. The delta can be positive or negative. So, positive delta means if the stock goes up, you make money, down, you lose money. Negative delta is like being short a stock. Stock goes down, you make money. Stock goes up, you lose money. So let's just kind of go back at this sort of makeshift rough estimate P&L diagram. Again, these are not exact with time spreads. They're just estimates. But if the stock is below the strike price, remember, it's the same strike price. I buy one call at a strike price, and then I sell a shorter term call at that same strike price. So both options share that same strike price. If the stock's below that strike price, I have positive delta. When the stock goes up, I make money. When it goes down, I lose money. I have limited loss because I can only lose what I pay for the spread. And once I get to the strike price, that's sort of my best case scenario. When the stock's above the strike price, I lose money. I start losing money or at least eroding profits. If the stock goes up a lot, I can lose money because I have negative delta. And as I approach the strike price, I make money. So really, guys, this is basically a picture of what I just described, negative gamma. If there's a big move in either direction, I lose money. But if the stock stays close to the strike price, I make money. I have positive theta. As each day passes, I make money. And then there's vega. I have positive vega. Now, hold on to that. Hold your thoughts on positive vega. I know for some of you guys, you're not familiar with vega, and some of you guys who are, you might look at this and say, okay, makes sense, I have positive vega. If volatility goes up, I make money. But that's not necessarily true. Positive vega, when it comes to time spreads, is a little bit, it's almost kind of misleading, and it's oversimplified. And I'm going to show you why, and I'm going to show you why that statement I just made is really important. So first, let's start with the basics, guys. The first thing you want to do is you want to analyze the stock chart. What kind of stock charts are we looking for with time spreads, guys? What are we looking for? What kind of technical setup would I want if I'm thinking about a time spread in a particular stock? Am I looking for, yeah, Steve's got it right on the money. Steve says range bound. I'm not looking for a stock that has a breakout to the upside or to the downside. I'm not looking for flag patterns or strong RSIs. I'm not looking for bullish stocks. I'm not looking for bearish stocks. I'm not looking at stocks that they're talking about on CNBC because they're such, big movers. I want to trade stocks that are actually kind of boring. I mean, when's the last time some of you guys traded 3M or Johnson & Johnson or GE? Those you fall asleep before you hit the send trade button, right? They're so boring to trade. So you want to look at stocks that are boring. You want to look at stocks where they're not going up, they're not going down, they're just in a boring old pattern, and as an investor, you'd never really trade them. And yeah, Tracy says they still can be money makers. You betcha. With options, you're not tied to like the old school way of trading. I don't care if a stock is bullish. You know, in fact, I can probably make more money in a sideways boring market or in a bearish market than I can in a bullish market with options. So look, guys, this is, if this is new to you, if you've never traded a time spread, you've never traded what we call income trades, like this is a whole new arrow in your quiver. Like maybe your normal thing to do is, well, you know, I'm going to get long when the stock breaks out to the upside. Maybe I'll buy a call when the stock breaks out to the upside. Good. I'm glad you have that down pat. I hope you have it mastered. But what happens when it's not a bullish market? This is a way you can make money when you otherwise can't. So, okay, another example here. Prices are not current here. This is totally just example purposes. We could buy the September 45 calls, sell the August 45 calls. So again, both calls, both the 45 strike, one's September, one's August. Buying the longer term one, selling the shorter term one. So I pay 177 on the longer term. I collect 104 on the shorter term. 177 minus 104 is 73 cents. I pay a net 73 cents here, right? Paid 177, collected 104. What's the most I can lose? 73 cents. What's the most I can make? I don't know while looking at this. Profit and loss diagrams don't tell me. Now, some of your brokers will draw not at expiration profit and loss diagrams. They'll draw out sort of like real-time profit and loss diagrams. Those are helpful guides. They don't actually give you, with time spreads, they don't actually give you fully accurate information. Again, they're the one sort of anomaly when it comes to P&L diagrams. Even the real-time ones that your brokers draw out. I know, like, if it's on your brokered screen, you kind of assume it's real, you know, and it's 100% reliable. It's a good guide, and I don't discourage you from using that, but you got to kind of take it with a grain of salt. If it says what's your max profit, it might give you a number it's not 100%. It might be close. Your break-even prices are estimates as well when it comes to time spreads. So we really want to take a good hard look at the Greeks. So because I'm buying the SEP 45 calls and I'm selling the AUG 45 calls, what I do is I say, well, basically I'm getting long 0.594 deltas here, and I'm getting short 0.4937 deltas here. So I just subtract this one from this one, and my delta is basically 0. It's totally flat. But, you know, just looking at that makeshift P&L diagram, I see, well, if the stock goes up a lot, you know, I start losing money because I get negative delta. And if the stock goes down a lot, I start losing money because I start getting positive delta. That's because you have a negative gamma here. And, you know, 0.054 negative, what exactly does that mean? I mean, what it means is that every buck the stock goes up, you get negative, you know, 0.054 deltas. Every point the stock goes down, you get positive 0.54 deltas. You know, don't get too hung up on the math with gamma. Just know that, JK, I do not. Just know that if there's a negative sign in front of the gamma, moves in either direction are bad. You know, a little move is okay, a big move is bad. That's really all you have to know. JK, I like you. I like your sense of humor. JK's making jokes, but I can't share them with you. Theta. Okay, now theta, what you need to know on the surface, plus sign, good. Plus sign means every day that passes, I make money. Now, I could lose if there's a big move in other direction. You know, I've got different factors at play here. Basically, volatility, you know, movement in either direction hurts me. Time passing helps me. So as long as the stock stays pretty stable, I make money every day. How much money every day? Well, 1.4 cents of option premium. Like, look, the spread is 73 cents. I'm going to make 1.4 cents tomorrow. If this stock stays exactly where it is, tomorrow it'll be worth 74.4 cents. Theoretical, there'll be some rounding. The next day, it'll be worth 76 cents. It gets worth a little bit more to me every day. I profit a little bit more every day. And why is that? Well, that's because this option that you sold decays every day. You lose a little bit of money every day. The option loses 3.5 cents of option premium every day, which is good because you're shorted. If I sell something, I want it to become worth 0. Now, this option that I bought, it loses a little bit of value every day too. It loses 2.14 cents every day, but that's okay because the one I'm short loses more than the one I have bought. That's why I end up with a net positive theta and I make money every day, as long as I don't lose on gamma. Okay, now, Vega. I mentioned it a little bit before. I said if you have positive Vega, what that means on the surface is as time passes, when the implied volatility rises, you make money. When the implied volatility falls, you lose money. But I haven't yet addressed what implied volatility is. I know from doing these presentations that some of you use implied volatility, some of you don't. I got a feeling that once I explain exactly the strength of using implied volatility in time spreads, once I explain that, I think every one of you guys is going to start looking at implied volatility. But we're not there yet. We'll be there in just a second. Let's talk about what criteria you need to set up a strong time spread candidate. This is what I call the market taker mentoring trading path. And a little background on this. So, my first trade was made down on the CBOE trading floor. A lot of people kind of look at trading, when you're learning to trade, what you probably do is, you start out small, you buy one call for your first trade, and then, you learn a little more, you get a little more confidence. Next thing you know, you're trading 10 lot spreads and that kind of thing. That's not how my life went. When I graduated college, I literally went down and knocked on every single door of the exchange building and got a job as a runner. I worked my way up from there, and next thing you know, I got my break as a trader. And I made my first trade as a market maker, as a professional. And after years and years of trading as a professional, making, sometimes I'd make 30, 40, 50 trades a day. Sometimes I trade over 1,000 contracts in one single trade, and not saying that to brag, just telling you what, that's how some market makers trade. I was one of the bigger market makers in my pit. When I started teaching non-market makers, one of the questions that I got early on was, well, what steps do I take to make a successful trade? And, after trading for years as a professional, making a trade to me was second nature. I processed the information in like a second, It's like anything else. Whatever job you guys have, you get good at it, obviously, and, to explain it to somebody who's never done it before, I don't know. My initial answers to those questions was, well, what do you mean what steps you take to trade? You just go trade, man. But I was asked this question enough, so I did a little soul searching. And, realizing that if I buy a call, or if I trade a time spread, or if I trade a straddle, it's a different set of steps for each of those trades. And if I'm a really conservative investor or a really aggressive trader, I do it a little different as well. So I wanted to come up with something that's universal. and 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 not just personalized to me. You know, when I make trades, oh, excuse me, when I train students, I don't really try to make you another Dan Pazzarelli. I look at who you are as a trader and try and make you the best trader you can be. I mean, everybody's different. Nobody's going to trade exactly like me or exactly like anyone else. Trading's kind of personal. So this is what I came up with that every trader should use on every single trade. You follow these 12 steps personalized to you and personalized to the type of trade you're making, you're going to be successful. Now, with time spreads, these 3 steps, they're a little overweighted. These are a little bit more important than other things. Now, George has a question. George, that's an awesome question. I'm going to answer that after I explain the rest of this. Save that for after the presentation. I definitely want to talk about that, okay? If I forget, you remind me. The MTM trading path, with time spreads, you need to do 3 things. Analyze technicals. Okay, look at technical analysis. Take a look at the news, and I'll talk about that in a second. Analyze volatility, and then you can select your time spread. So, what, technicals, we already talked about that. That's actually pretty easy, pretty straightforward. We're looking for a neutral setup. We want to select a stock that has support below the current stock price and resistance below the current stock price. If I can get that on multiple time frames, I love it. I need that channel to have existed for at least 6 weeks. And if I assume that that channel will continue, then I might have a good time spread candidate. Now, one of the factors in determining whether I think that channel is going to continue is I've got to see when the news is coming out. Because the thing about options, they're a little more complex than trading stocks and futures. I mean, there's time, there's volatility, there's dividends, there's other things that affect the value of an option above and beyond what affects the value of a stock. There's more to it. But so in one regard, that makes options trading a little harder. But in another regard, it actually makes them easier because it's more about volatility events. And some volatility events are telegraphed. The government and the corporations tell you when certain volatility events will happen. Earnings. Look at a typical stock chart. Most companies, when they have earnings come out, that's one of the biggest trading days of the year. Sometimes stocks gap up huge or down huge on earnings days. So what's one of the enemies of time spreads? Volatility. The stock gaps up huge or gaps down huge and you lose your shirt on a time spread. So guess what? Don't put on a time spread going into earnings. Now, like anything else, there are times when we can violate that rule, but if we're looking at time spreads, simple, straightforward, as an income-generating strategy for kind of boring stocks, way to make money in sideways markets. If earnings is coming out before the short option expires, don't make that trade. Instead, try and use maybe a weekly option, sell an option that doesn't have earnings in the life of the short contract. Then you avoid a potential blow-up. You avoid a trade where if the market moves big in either direction, you lose. Now, other things, like if you're trading the spiders or diamonds or the Qs or something like that, you know, you might consider avoiding, you know, some of the big financial numbers. Unemployment is almost always important to varying degrees. Fed announcements are likely to become pretty important things. I mean, those are always important to some degree. They're likely to start becoming very important again. when the corporations or the government tells you, hey, we're going to announce a number on this date, and the underlying is probably going to move a lot, that means don't have a time spread. So, perfect. You can't avoid all big volatility events, but you can avoid the ones that you know are guaranteed to be volatility events. Then we come to the third analysis we have to do, volatility analysis. So, okay, let me start with this question one more time. How many of you use volatility analysis in your trading? I know all my students are going to say yes. Okay. So I got a good number of yeses. And you guys who are commenting, it's really helpful because I get a lot of comments and questions. It's really helpful if you kind of stick with the program and, you know, answer the questions or maybe ask a relevant question. It'd be great. So many of you guys said that you do. I got a few no's. So I appreciate why some people don't look at volatility. It's kind of esoteric. It kind of doesn't really make sense at first, you know. You might look at it and say, I don't know, seems kind of complicated and seems like it doesn't really matter. But especially with time spreads, it does. So this is a refresher for some of you. This is a crash course for some of you as well. Dom, I'm going to get to that question in a second. Realized or historical volatility, that's a measure of how much the underlying stock moves up or down, okay? It's stated in terms of annualized standard deviation. Now, don't worry about the fancy math. Just get used to looking at volatility charts with realized volatility, okay? Get used to looking at these numbers and looking at these charts. I'm going to show you a couple of these charts in just a second. Basically, what that measures is your gamma risk, right? We said negative gamma means if the underlying stock moves too high or too low, you lose money. Realized or historical volatility, if it's really high, that means the underlying stock is moving a lot. That means that negative gamma risk, you know, you have a good chance of getting hurt. So you're looking more for lower realized volatility. Now, there's another type of volatility, and I mentioned it before. Implied volatility. See this definition I have there? Forget it. It's too complicated. What implied volatility is it's how cheap or expensive options are. It's a relative figure of how cheap or expensive options are. Now, it's stated in terms of annualized standard deviation as well. So it's stated in the same units as realized volatility, which makes it easy to compare them. So look, this is a volatility chart. Well, and let me just address a couple of questions here. And Dom, I'm going to hold yours for a second. John says, all those announcement days make it hard to find a day to trade. Well, yeah, John, but the question is, do I want to make money or lose money? I mean, look, if trading was easy, everybody would do it. You wouldn't be in this class. You need to learn how to find the good trades and throw out the bad trades. And there's more bad trades than good trades. So yeah, it's hard to find. I mean, it's not like you're going to look at one stock chart and say, oh, here's a winner, let's trade it. You're going to probably look through about 15, 18, 20 stock charts, and you're going to throw a lot of them out because of things like earnings and all that. And that's okay. Look, there's thousands of stocks to trade. Only make the good trades, and that's what I'm showing you how to do. Carl says, Carl, I don't know, but I'm reading all the relevant questions here, so don't worry. Okay. The red line on this chart is implied volatility. The grayish blue line is historical or realized volatility. So let's start with the grayish line. Basically what this means is it's how much the underlying stock has moved around lately, right? That's what historical or realized volatility is. Right now, the stock is moving, at a 29 volatility. Now about a week ago it was moving at a 25 volatility. So what does that mean? It means the stock has gotten a little bit more volatile, basically. Now a long time ago, back here in the end of April, it was at about an 18 volatility. So this gives us an indication as to how much the underlying stock is moving. Considering that's incredibly relevant to us, because if the stock experiences a lot of volatility, moves too high, moves too low, I lose money, I want to know that. Now the red line here on this top chart is implied volatility. That's how cheap or expensive the 30-day option is. So look, here the 30-day option is about 32% volatility. This is an indication that volatility is expensive. Why? Because look, implied volatility, or how cheap or expensive options are, it's 32 now, but a couple weeks ago it was about 25. So options have gotten more expensive lately. And if you look back, this is a 6-month chart, except for this one big spike here. This is about near the top of that 6-month range, right? So it's high relative to itself, and it's also above historical volatility. This top chart is a chart of options that are slightly overpriced. This bottom chart is a chart of cheap options. So we have the historical volatility here, it's about 60, but the implied volatility, how cheap or expensive the options are, fell from a couple weeks ago, it was about 72, now it's about 45, and it's below historical. So this gives us, and D, who just asked which stock is this, it doesn't matter. This is just an example. This is an old chart. I'm just trying to show you how to read these charts. This stuff is so important. Like every time you guys buy an option, just like, if you're buying an insurance policy, you buy an insurance policy on your car. Well, they all do the same thing. They all pay you for a new car if you crash your car, but do you just go to one insurance guy and say, hey, how much is the insurance policy? It's $1,000 every 6 months? Okay, I'll pay it. Or do you shop it around and see which policy is high and which policy is low? I mean, do you care if you pay $1,000 every 6 months or $3,000 every 6 months? Does that matter to you? Should, right? You guys are good consumers. You shop that stuff around. You don't want to get ripped off. Well, you don't want to get ripped off by the options market either. So when you buy options, you need to buy them when they're cheap. When you sell options, you need to sell them when they're expensive. That's what implied volatility and using volatility charts enables you to do, and that's what you can do with time spreads. Take a look at this. Look, in this example, price is not current. This is just an example because it's a sweet example. It's perfect. I could buy the longer term option, these April calls, at a 50 volatility and sell the shorter term March calls at a 60 volatility. So look, trading is all about buy low, sell high, right? Look what I'm doing here. I'm buying low and selling high at the same time. I'm buying one option that's cheap relative to the other one. I'm selling one that's expensive relative to the other one. This gives me an edge on my trades. I mean, some people look at trading as, gambling. You're just taking a shot. Great. You're a gambler. But some people, the smart money, and this could be you, they look at trading as the casino. Like, look, I don't know if I'm going to make or lose money on this. I do all my research. I think I have a pretty good trade here. I don't know for sure what's going to happen. Nobody ever does, right? But I know that if I make trades that have an edge here, and I'm selling an option that's overpriced, and I'm buying an option that's underpriced, I know that in the long run I make money, just like a casino. When you put money down on the blackjack table or the craps table, they don't know if they're going to win that hand, but they know they have a statistical edge in the long run. And the more you play, the more they make in the long run. They want to see millions of people come in and make $25 bets. That's what you do as a trader. And using volatility is the only way you can do that. I got a number of questions here. Chris says, I always look at implied volatility. It's very helpful for me, but I haven't figured out how to find the historical. How do you find that? Well, the historical volatility, well, the volatility charts that I was using, guys, are from a company called LiveVol. If anybody is interested in taking a look at them, I got a guy there who will help you out. Send me an email. My email is dan@markettaker.com. That's dan@markettaker.com. Chris, do you mind if I just respond to your question here and put my email there so people can just kind of click on it or copy it? Is that all right? Okay. So, I mean, if you need a good source for volatility charts, I got a guy. That's how we say it in Chicago. I got a guy. Just email me. Wilson says, how about implied volatility rank? Okay, so Wilson, George asked the same thing earlier. Wait, was that George? Somebody asked the same thing earlier. I forgot what you asked, George, but I'm going to get to it. So what's a high volatility? What's a low volatility? How do I do that? It's relative. Like here, I'm glad buying a 50 volatility because it's below this 60 volatility. To me, this is cheap and this is expensive. Now, some people might say, oh, a 50 volatility, well, that's high. Not necessarily. If the historical volatility is like 55 or something, that's great. I'm buying below historical, selling above historical. It's all relative. It's all relative. So what you care about, and somebody, who was this? Wilson just said he was asking about the rank. You can, I mean, like LiveVol, like I was talking about, they'll enable you to calculate a volatility percentile. The option you sell, ideally, should be in the top half of the 50th, above the 50th percentile. The option you buy should be below the 50th percentile. That's the ideal. Then you're selling an overpriced option that you're basically getting more money than you should for it, and you're buying an underpriced option, you're paying less than you should for it. That's the casino, not the gambler mentality. That's what traders who make money in the long run, that's how they think about it. So look, it's not a big stretch. If you've never thought about it that way, it's fine. Now you can. Now you understand this. This is so important. This is the key to making money in time spreads, guys. Dom sent me an email, dan@markettaker.com, okay? So look, this is, thanks JK, this is pretty simple and straightforward. If you traded time spreads before but you never used volatility, great. You had the basics down, but now you have the ability to actually turn that into a potentially winning strategy. Now you've got a long-term plan. Okay, so a couple things. Look at your volatility in the option chain always, and then make sure you read the news. Make sure earnings isn't coming out. Make sure, make sure there aren't any potential volatility events. Now, I've got a few questions sitting here waiting. I need to tell you about something. I gave you the ability to go out and find time spreads on your own. It's labor intensive. Somebody said, well, if I filter out all the ones that have earnings, it's hard to find trades. You betcha it's hard to find trades. Trading is labor intensive. It takes you a long time to find trades. It might take you a half hour of sifting through different charts and looking through different news stories and throwing out 18 trades before you find a good one. I have a way to help you not worry about all that labor. We'll do it for you. How'd you like to have all the trade ideas you need? How'd you like to have 15 trade ideas every day from somebody who's been in the options business for 25 years and used to work for Goldman Sachs? Well, I've got a class. Enroll in the Market Taker Live Advantage group coaching and get 3 months of trade ideas. So you get, this is over 20 trade ideas. It's actually 15 trade ideas every day. That's about 1,000 trades in a 3-month period. These classes are every single morning at 9 a.m. Central Time. That's 10 o'clock New York time. It's a half hour after the market opens. They're an hour long. They're every single day for 3 months. You get fresh trade ideas. Now, what if you're on vacation? What if you have to work at that time? What if you miss one? Classes are recorded. You never miss one. It's no problem. Half our people don't even attend the live ones. They just watch the recordings. These aren't like day trades where you have to get in right this second. So for 3 months, I mean, look, the way we have this price, it's normally $1,000 every 3 months, or $1,700 every 6 months. That's because, I mean, for God's sakes, you get 15 trade ideas a day for 3 months. You make money on 2 of them. You know, you're in the green already, right? It covers the cost of the class. But this is a pretty special event, and I don't do this all the time. In fact, this is probably the last time you're ever going to see this price. If you enroll now, you're going to get this for half price. Enroll now, you get 3 months of trade ideas. That's over 1,000 trade ideas for only $497. I mean, you make money on 1 trade idea that covers the cost of the class. I mean, just 1 pays for itself. Ready? 1, 2, 3, go. MarketTaker.com/3 months. MarketTaker.com/6 months. Okay, JK. We'll see if you're JK. Just kidding. MarketTaker.com/3 months. MarketTaker.com/6 months. But you know what, guys? That's not it. I'm going to sweeten the deal. I'm going to sweeten the deal. I'm going to give you these bonuses. I'm going to give you full access to the options impact videos, which are 8 classes. This is for basic people. Those of you who are advanced, you're going to benefit from the other stuff. If you're brand new to options, you're going to love this. The options impact videos is 8 video classes plus 30 short form videos. I sell that on my website for $4.97. You're going to get it free. I'm going to give you access to the email hotline. You're going to get a full month of unlimited email question access to us. If you've got a question, you send us an email, we'll get it answered. There's 3 of us instructors here. Between the 3 of us, we've got 75 years of options business or of options industry experience. 75 years between the 3 of us. You have any question, you're going to get it answered. I mean, don't get me wrong. You know, I've been doing this well over 20 years myself. Maybe I don't know everything there is to know in the world, but I ain't been stumped yet. If you have a question about just general, hey, how do I trade this? You know, or a specific question about, hey, look, I've got this call spread on an Apple and I'm losing money. Is there an adjustment? Send us that question. Plus, you're going to get access to our MTM Elite Traders Club, which is our version of a chat room, but it's much better. It's more like Facebook for traders, where you can interact with other traders, post charts. It's great. You're going to get about $2,000 of free bonuses, but you have to sign up right now. MarketTaker.com/3 months or MarketTaker.com/6 months. MarketTaker.com/3 months or MarketTaker.com/6 months. And for the first person who enrolls, you are going to get a copy of my book, The Market Taker's Edge. I'm going to drop it in the mail, probably Monday. An autographed copy of The Market Taker's Edge for the first person, so hurry, 1, 2, 3, go. Do I have any questions about this class, the 3-month or 6-month program? That's the group coaching. Or do I have any questions about the material that I just covered? Jerry, yes. Okay, I got a couple people saying they want to sign up for the 6 months. I mean, the 6 months is definitely the way to save a little bit of extra money, you know. So yeah, 6 months is the way to go. Do I have any further questions? Anybody? George, JK says, I know you do not trade against your clients. You're right. I absolutely do not trade against my clients, right? John, this is half price. You don't need a coupon code. It's already half price. You will not see this price again. Okay, so you know what? Christian is telling me that we are all set, so it is time for me to go. I will see you guys next time. Thanks for attending my session. Talk to you soon. Bye.
Thank you so much, Dan. What a wonderful presentation. I know I was excited, and I could see all the interaction with everybody else being excited. So great job, Dan, and thank you again, and we'll see you soon here back at our invitation in Market Traders Institute.